Hello everyone, today I am here with the short overview on the State Bank of Pakistan monetary policy decision that is announced today as on January 2025. Here we are going to discuss about the factors that influence the policy rate um, of Pakistan by the Central Bank of Pakistan, that is State Bank of Pakistan. Monetary Policy Committee observed the following developments since last meeting that was held on December 16, 2024. First of all, observed slightly lower real GDP growth in the Q1 for the financial year 25 than the expectation. Current account remained in surplus in December 2024, though the State Bank of Pakistan foreign exchange reserve declined among the low financial inflows and the high debt payments. Tax revenue remained below as targeted for the first quarter for the financial year 25, despite a substantial increase in the December. Global oil prices have exhibited heightened volatility over the past few weeks. Global economic policies environment has been more uncertain, promptly central banks to adopt a cautious approach. Considering these developments and involving risk, the committee viewed that a cautious monetary policy sustain is needed to ensure price stability, which is essential for sustainable economic growth. Monetary Policy Committee assessed that the real policy rate need to remain adequately positive on a forward-looking basis to stabilize inflation in the target range of 5 to 7%. Now, real sector, the latest high-frequency indicators, despite it continuing momentum in the economic activity, notable increase in the automobile, petrol, oil, lubricant, and fertilizer sales, as well as in the import volumes, electricity generation, and the credit disbursement to the private sector. Provisional data of the real GDP for first quarter financial year 25 showed a modest growth of 0.9% against 2.3% growth record in first quarter for the financial year 2024. Slowdown was primarily explained by the expected sharp decentralization in the agriculture sector growth to 1.2% in the first quarter financial year 25 from 8.1% in the same period last year. Latest available information for wheat crop, including satellite images, are also pointing towards a relatively modest output. Meanwhile, the decline in the industrial sector growth in Q1 financial year 25 moderated relative to last year. Monetary Policy Committee noted that the turndown in LSM, which has been pulling down industrial growth, has been driven by a few low-weight items such as furniture. Key industrial sectors such as the textile, food and beverages, automobile has shown notable improvement. Moreover, the business confidence index has continued to show positive sentiments. Going forward, the Monetary Policy Committee expects economic activity to gain further traction and the real GDP growth to remain in the earlier projected range of 2.5 to 3.5%. External sector, driven by the strong workers' remittances and export earnings, The current account posted a surplus of $0.6 billion in December, bringing the cumulative surplus to $1.2 billion during half year for the financial year 2025, led by HVA textile. Export maintained a strong momentum. At the same time, import growth also shown broad-based acceleration on the back of high volumes, pointing towards the improvement in the economic activity, while the import bill outpaces export earning remain inflows more than the offset the widening target deficit. Based on these trends, particularly the repost workers remittances, the output for the current account balance has improved considerably and is now expected to remain between a surplus and a deficit of 0.5% of GDP in financial year 25. Net financial inflows through debit during first half financial year 25 are expected to improve going forward as a sizable part of the official debt payment has already been made. Consequently, the improved current account outlook, along with the expected realization of the planned financial inflows, is likely to increase the State Bank of Pakistan foreign exchange reserve beyond 13 billion by June 2025. Fiscal sector, the FBR revenues. FBR is Federal Board Revenue, recorded a notable increase of around 26% during first half for the financial year 25. Shortfall in tax collection from the target has burdened, according to a steep acceleration in the tax revenue growth would be required to achieve the annual target. Estimates from the financing side suggest an improvement in the fiscal balance during first half financial year 25, indicating relatively continued expenditures. Committee viewed that the anticipated lower interest payments than the budgeted amount is likely to contain the overall fiscal deficit around its target. However, achieving the target for the preliminary balance would be challenging. Inflation outlook. Headline inflation remains on its downward trajectory and ease to 4.5% year to year in December from 4.9% in November. Declining trend in inflation is mainly led by the downward adjustment in the electricity tariff. Adequate supply of the key food items lead to lower level of the food inflation, stability in exchange rate, and favorable base effect. Underlying inflationary pressures, as indicated by the core inflation, also moderated amidst contained domestic demand through these remain elevated. Moreover, inflation expectations also remain volatile. Based on these trends, the Monetary Policy Committee reiterated its earlier assessment that the near-term inflation will remain volatile and is expected to increase close to upper bound of the target range towards the end of financial year 25. On balance, the Monetary Policy Committee expects headline inflation for financial year 25 to average to average between 5.5 to 7.5%. Going forward, inflation outlook is subject to the risk emanating from the volatile global commodity prices, protectionist policies in the major economies, timing and the magnitude of the administrative energy tariff adjustment, volatile perishable food prices, as well as any additional measure to meet the revenue target. The State Bank of Pakistan monetary policy decision in the meeting held today as on January 27, 2025, in which the committee decided to reduce the policy rate by 100 basis points to 12% effective from January 28, 2025, based on the factors we have discussed. The Monetary Policy Committee assessed that the impact of the significant reduction by 1,000 basis points in the policy rate since June 2024 will continue to unfold it and further support economic activity. It means they are planning to further reduce the policy rates. Definitely, it will give positive impact to the industrial lending, but on the other side, affect the investors' deposits within the financial institutions. Thank you very much. See you again with the upcoming video on as soon as it counts.